In this video, I'll share with you our analyst's outlook for Latin America in 2015, as well as the management priorities of the multinational leaders we work with. Latin America has seen a significant slowdown in growth in the last couple of years, and FSG analysts don't see a quick turnaround on this. As a matter of fact, the growth rate that you see on this slide of just barely over 2% for the region on average could slide further down in our downside scenario to about 1.5% through 2020. Now, that's not inevitable. We actually have an upside scenario. We could imagine a bounce back to closer to 4%, kind of getting back to 2004-2012 levels, but it's by no means guaranteed. And in fact, we have a bit of a downside bias on overall growth rates across the region. But things, of course, get really interesting for multinationals when we unpack that. So take a look at the policy mix that's really driving the divergent economic outcomes for Latin American countries. What we see is that the relative orthodoxy, or as you could say, heterodoxy or political nature of policymaking for the economy really drives the economic outcomes that we see. That's what's color-coded in this particular slide. Green is more orthodox, more sound economic management, tighter budgets, less debt, and red is heterodox, more subsidies, more catering to specific interest groups, more debt. And it has clear impact on the economic growth that we see, where both Venezuela and Argentina have shaved a massive chunk off of their GDP growth just in the past year, and Brazil has really faltered as it's flirted with pretty heterodox policies under Dilma Rousseff's last year in her first term. But when we look at the underlying drivers that enable multinationals to invest and grow, our biggest concern is not overall headline growth. Our biggest concern is the health of the middle class in Latin America. This has been the foundation of consumer spending and a lot of small business investment and the development of critical local partners for multinational companies that are trying to grow. And as government policy becomes unsustainable, government spending and subsidies become unsustainable, there's a real concern that our analysts see that middle class entrants who've just moved up from being relatively poor in recent years will fall back because they won't be able to sustain that same level of spending. It won't have been based on productivity and their own ability to sustain employment. So we forecast a rise in 2015 in unemployment generally and an only very modest rise in disposable income, bouncing back from the 2014 dip where it came close to no growth. A sobering picture, to be sure, but we think that's grounded in a realistic understanding of the policy implications domestically and the international environment. That's what you see on the following slide. It's critical when understanding the Latin American expectations to look at linkages with other parts of the global economy, especially commodities. When you look at recent export earnings from Brazil or Mexico, from some of the Pacific economies that export agricultural goods, or from a Venezuela that exports hydrocarbons, across the board, the storyline gels pretty clearly. We've seen a slowdown, and that really puts a dampening on government revenues and the ability to then feed that back into the economy. And we don't expect that to change. FSG's expectations for oil prices is to remain quite low in the $80 range through the year on average in 2015, and for commodity prices to be quite restrained as growth continues to slow slightly in China and other key manufacturing economies. All of this hits Latin America as much or more than any other region. So what does this mean for really the key markets that tend to drive the corporate top and bottom line in Latin America? Well, for Brazil, we've seen a stall in 2014, technically into a recession in the first half. And even under the re-election of Dilma Rousseff as president that should establish some stability, we don't yet see a clear mandate for a dramatic shift in policy. That means that investment and consumption will likely both stay pretty restrained, even if government spending increases. And frankly, the government spending that we've seen hasn't stimulated the economy enough to create a big turnaround in what is the biggest market for most MNCs. So where do the bright spots come? Well, the bright spots we think will come from international linkages, but from a different source. Instead of relying on exports to China, we'll actually be seeing the markets that respond to U.S. demand picking up the most. When you see the exports to the United States on this chart here, Mexico and Colombia are best positioned to benefit. Their exports to the U.S. are substantial as drivers of the economy, and unlike, say, Venezuela, they're very well positioned to capitalize on that, both in terms of generating a lot of business investment with those funds and also being a hospitable environment for foreign direct investment from MNCs. The Mexico reform story in particular is finally starting to take shape and rippling through the economy there after a somewhat disappointing delay in 2014. So what does that mean for MNC strategy? We asked our general managers that we assembled in an event in Sao Paulo last month what their priorities were, their expectations for revenue growth, and interestingly enough, for 2015-16, the big bet is still Brazil. It's not that the Brazil economy is expected to be the most dynamic, but it is for many multinationals still the most underpenetrated. They may have operations in Sao Paulo, in Rio, but still be far away from some of the northern provinces in terms of capitalizing on the market potential there. So regional expansion within the country is an active area of interest and expectation for lots of clients. The news this year is the higher expectations for Mexico and a greater confidence that those will be fulfilled as the economy really starts to upswing. Interestingly enough, it's an even bigger upswing in Mexico when we asked about profitability potential. Almost 2/3 of MNC clients polled said that Mexico was going to deliver their top profitability in 2015-16. Much, much more conservatism in Brazil, where despite the slow growth, there's continuing escalation of costs, especially in the labor market. Now, of course, you can only capture growth if you're able to organize around it. That theme comes through very clearly when we asked our Latin America general managers what capability was most important for them to improve on in 2015. They said building a strong organization. And for LATAM executives, that means not just improving the effectiveness and deployment of their talent, but also the organizational structure itself. A lot of LATAM executives are asking us how to adjust their organizational footprint, think about different kinds of hubbing options, shared services, where to put regional headquarters of various types, and so on. Click on any of the other videos highlighted here to see our analysts' outlook for other regions in the world.